Hey, folks, how's it going today? Um, Sorry I had to miss Monday. I had a funeral that I needed to go to. It's been a high stress week, of course, with everything going on in the market. But happy to talk about what's going on in markets today. Happy to talk about what's going on in banking. If you guys are paying attention to my post this week, you would have seen a general lack of concern for what's going on, as I kind of had the opinion that this is really going to be limited to mostly out on the West Coast. It has seemed to have had effects overseas as well. I did want to talk about Credit Suisse today. Once again, Credit Suisse, though, it is a truly unique case. That has been a bank on my hate list for quite some time, and not because of anything that they've done currently. It's because they have a long, long history of corruption, of bribery scandals, espionage scandals, all kinds of things. And I'm a little surprised at the dedication to which the Swiss government has made in keeping Credit Suisse open. So, and I'm a little surprised by that, but then I'm not. There is a systematic risk with that bank imploding, but Credit Suisse has never been my favorite bank for a number of different reasons. But let's talk about what's going on right now. The next domino that was possibly going to fall, and yeah, I'm actually going to talk about Xpeng here a little bit later in the live stream. I'm gonna get to some of that, and we're gonna talk about why their expenses have been so high, some of the demand concerns that I have, but I no longer have any production concerns whatsoever, and we'll talk about why that is here in just a moment. All right. Okay. So why we should care about Credit Suisse's problems? You can see here just this massive crash in basically the 2008 recession. They've never ever recovered their former glory days since prior to 2008. The 167-year-old banking behemoth is not a domino falling in reaction to bank failures in the US. Its troubles are of its own making and have been cascading for over a decade, and still its dire predicament could hardly come at a worse time for the global financial system. So, one of the things that's not really understood very well by people who are in the banking industry here in the United States is that the lack of investment opportunities in Europe over the last decade essentially forced almost all European banks to buy government bonds that sometimes had negative yield. Okay, this was a huge deal going into that. So at some point, it had to be on regulators' minds and central bank minds that these banks were eventually going to need a bailout at some point, because essentially they had been supporting liquidity measures at their own risk for quite some time, and now some of that has to come back. And Credit Suisse has been scandal prone for decades, according to this article, with a long history of involvement in bribery, money laundering, tax evasion, corporate espionage, subprime shenanigans, and terrible risk management. This is absolutely true. And like I said, since 2008, they have kind of been on my list of naughty companies, but really their involvement in and very shady things goes all the way back to World War II, where there were some of the primary. I'm not going to get into politics here. Let's just say that they are involved with a political party that starts in an N and ends in an I. Heavily involved in that. Also, their banks, combined with Swiss bank secrecy laws, they prevented a lot of assets from dead people that died or people that died in the Holocaust. Prevented assets from being recovered by their descendants for 30 or 40 years in some cases. So this is a bank with a long, long history of doing shady things, and it's finally coming back to really, really bite them. So Credit Suisse is not our issue. There is a risk of contagion with this, but the Swiss central bank and banking regulators stepped in to show support, of course, and they extended a $54 billion credit line to the company. That is one of the things that's going to help calm liquidity concerns. So let's talk about what the liquidity concerns mean. And the one I'll take a look at right now is really First Republic Bank, FRC, and let's talk about the concerns that they have here. I don't remember exact numbers. I've been reading about it all morning, but I don't necessarily remember exact numbers. But this stock has been all over the place the last couple of days. I've made some money, some real short-term trades by buying and selling, going in and out of the stock and options course. It's just look, and it's like their business doesn't really look like the business of Silicon Valley Bank or of Signature Bank. Signature Bank, it wasn't anywhere near as heavily involved in venture funding as Silicon Valley Bank was, but it did cater to those high net worth individuals. And it only took a few of those high net worth individuals and companies to diversify their deposit base. And then we ended up seeing a bank run there. First Republic Bank is seeing a bank run, but in reality, they're in much better condition. Less than 4% of their assets are actually in tech. They do have quite a bit of exposure to commercial real estate, which is an issue, especially now that all of those leases are going to be coming up pretty soon. But they're in much better shape. Now, what do they mean when they say that asset values have declined? Well, back as late as 2008, all the way up through roughly 2018 or so, these companies were buying very long dated bonds that were paying 1, 2, maybe 2.5% in that time period. And the value of existing bonds has dropped because interest rates have risen, which means that new bonds do have higher coupon rates, which is going to push down the value of existing bonds. Now, this means, of course, that in a perfect world, this really wouldn't have upset anything if it hadn't been for a bank run. And if it hadn't been for Silicon Valley Bank's unique position where they service all of these startup companies who are all pre-profits, at least, if not pre-revenue in a lot of cases, where they started eating into and using all of those venture funds and taking money out of their accounts slowly. That really started in November of 2021, has been a slow bleed since then. A lot of these banks have struggled to maintain deposit numbers. When you look at a bank like Silicon Valley Bank, it was it had $70 billion on deposits or so back around 2018. Some restrictions were lifted. Some oversight was lifted. At least the defined schedule of oversight was listed. It could have been subject to stress tests at any time. At this point, no one's actually clear if it was stress tested between 2018 and now. And that's what I find to be fascinating. But these restrictions were lifted on banks that had between 75 billion and 250 billion on deposit. Between that time period, Silicon Valley Bank went from being a $70 billion bank to a $210 billion bank. And at no point, as far as I can tell, was it ever stress tested. So kind of a big concern there. So First Republic Bank, not in that same ballpark. But it looks like a deal is being worked out with First Republic Bank and a number of other banks. And the big one that I mentioned on Monday, probably being a big owner of First Republic Bank, is going to be Morgan Stanley. And it looks like from the reports that I've seen that JP Morgan, rather. It looks like from the reports that I'm seeing that JP Morgan is going to take a huge chunk of this on through a lending facility for First Republic Bank. So that rescue looks to happen. We don't know what exactly that means in terms of an equity position that this consortium of banks is going to take with First Republic. If there is an equity position, if there's going to be dilution, we don't know any of that, which is one of the reasons why the stock price is still going to be all over the place for the next couple of weeks. So yeah, fire away with any questions you guys have. This banking crisis this time around is nowhere near as complex or widespread as the 2008 financial crisis. This is a not unique. This is a feature of the fractional reserve banking system, that if you bring in tons of money and you only keep 5, 6, 7 cents of that money on the dollar actually on deposit, occasionally you are going to end up taking too much risk. There's going to be a run on your bank, and you are going to need to be bailed out by the FDIC. What we're really learning about this is that the FDIC, since 2008, if you are judged to be a bank too big to fail, then they are getting the deposits of all at this point. Which, it's not the depositors who should really suffer in it. Really is the bondholders. That is the risk that you take when you take ownership or loanership, as it's called, by being a bondholder with any of these banks. You are the one that assumes the risk of that investment. The depositor is supposed to assume no risk. So, eager to hear your thoughts on the Moneyline earnings news. So I did take a look at Moneyline earnings. I'll get to that here in just a moment. Just wanted to give everyone a moment here if they had any questions about banking, the banking crisis, what's going on with that. And yeah, so really it's banks that do most of their business around the San Francisco area that are most going to be affected. And I would assume that banks that are doing business around the Austin area too, we're likely to see some trickle down effect, as some of those banks are going to be heavily invested in venture funds as well. So those are the two centers of venture capital dollars in the last 5 years or so, the ones that have really benefited from the deregulation that passed through Congress with the help of, it wasn't all the Republican Party. They had the help of 75 Democrats who voted for it. And so this is really a bipartisan failure to regulate banks in a lot of ways. I will say one thing. There have been a number of people who've been out there saying, oh, this is what happens. You go woke, you go broke. That has to be one of the dumbest takes I've ever heard on why a bank failed. It had nothing to do with that. It had everything to do with Silicon Valley Bank. And really kind of Twitter, David Sachs and Peter Thiel leading the charge on a bank run, where basically $42 billion disappeared out of Silicon Valley Bank in a matter of like 2 days or something. So that's kind of the issue with that. But as someone who keeps billions of dollars on deposit there, and it is uninsured, you have the right to do that. You have not only the right, but the responsibility to your shareholders. If you're Peter Thiel and you run a hedge fund, you have a responsibility to your shareholders to make sure that the assets that you have under management aren't at risk because of a bank failure. So I'm not blaming anyone in this case but the management of Silicon Valley Bank. Their business was not well diversified enough. And it may be that no one's business really is that well diversified enough in that particular area. Everyone's going to be heavily involved in commercial real estate, which has seen an apocalypse essentially since 2020, since COVID. We're still seeing, based on reports that I'm seeing, that office occupancy is about 50%. And as these leases come up for renewal, folks are not going to be renewing their leases with the same amount of office space. That's going to impact the performance of commercial loans that are out there. And we're also seeing, of course, that the unrealized losses of bonds declining, bond portfolios declining. And like I said, things all being equal, with no bank runs and emergencies, in the long run, this would not be a big deal. They would simply sit on those bonds until they matured, and they ended up getting their the par value of the bond back. That's what would have happened in normal cases. So what the Federal Reserve is doing right now, what the FDIC is doing right now by guaranteeing depositors that their money is safe, not investors in the banks, not bondholders in the banks, but guaranteeing that depositors, their money is safe. They are stopping these bank runs and hoping that some of the unrealized losses will remain unrealized losses, instead of forcing sales of assets at a loss for these banks. And they will instead be given credit facilities arranged right now by other large, well-capitalized banks who were put through these stress tests because they were large enough to do so. So at this point, probably none of the top 15, 20 banks in the United States are going to be, at this point, I think Silicon Valley Bank was the 20th largest bank in the United States, but none of the other top 15 or so are in danger whatsoever. I mean, there's a non-zero chance that one or two of them may go under, but in non-zero, it's close to zero. In terms of First Republic Bank, there is a non-zero chance that they go under. And I would say that's a little bit higher, even with the credit facility, $30 billion credit facility that looks like it's going to be offered to them. There's a non-zero chance that they still go under. However, I think that they will probably end up being rescued, especially as depositors and everyone else realizes that they are not as big a risk because they weren't strictly focused on servicing those high net worth clients. But it was a real quick turnaround for them. They went from taking a 6-person team from a large wirehouse, bringing them into First Repulic Bank. This team had billions of dollars under management under their under a former wealth management company. They brought them in. They went from high flying corporate raiders to corporate beggars in basically a matter of weeks, which is a pretty stunning turnaround. If this Wall Street Journal article, which is behind a paywall, But if you have only looked at a few free articles this week, this is a pretty good thing to look at. And this is what happened to Silicon Valley Bank. Very short Wall Street Journal article. And this article from Axios explains fairly succinctly and shortly why I hate Credit Suisse. I mean, it's literally a single page. Why I hate Credit Suisse. And the fact that it is a business that is too big to fail, but it's the Swiss government's responsibility for doing this. Yeah. So, okay, on to a couple of other things. Taking a look at Xpeng at this point, Xpeng's stock, this earnings is actually going to look really bad and probably worse than consensus earnings. And but I do think that if demand can recover in China, that the future of Xpeng looks a little bit brighter, and there's one good reason why. So earnings have really been in the toilet recently because of the expense of all of the new factories that they're building. They did complete a factory on February 21st of this year. It didn't make a bunch of news, and I have not talked about Xpeng in a while. But the Guangzhou facility, which can produce about 200,000 vehicles, is about 200,000. Let's just look at that real fast. So anyway, the consensus earnings is negative $3.22 for 2023. I think that the lowest EPS forecast of minus $9.82 is probably closer to the mark. I'm going to bet that it's going to be somewhere around $7.50 to $8 loss per share for 2023. But by the end of the year, their capacity to produce vehicles is going to be close to 500,000 a year. Let's talk about that. Now, granted, remember the last 2 months or so have been affected by further COVID shutdowns and also New Year, right? The Chinese New Year. Chinese New Year always affects earnings, always affects deliveries, and always affects sales for about a 2-week period in the year. Every year, people that don't invest in China forget about this and they panic over declining delivery numbers. So the issue with that is that NIO numbers recovered in that time period. They're still barely above where they were last year. Xpeng's really did not. And that had to do with additional shutdowns that happened in Guangzhou. They were shuttered for a little bit. Okay. So the Chinese electric car manufacturer Xpeng has commissioned its new production facility in Guangzhou, China. The plant has an annual production capacity of 120,000 vehicles, and they're going to manufacture that new G9 SUV. They started construction of the new factory in September of 2020, and it just got finished this year. So the other plant they have in Zhaoqing is currently being expanded to an annual capacity of 200,000 vehicles. So it's a total capacity of about 320,000. And a third Xpeng plant is going to be is currently under construction in Wuhan, and that looks to be completed by fourth quarter of this year for an additional 100,000. So from what I understand, the factory in Wuhan may actually end up having a greater production capacity than that, close to about 500,000 units per year. This is where their loss is going right now. It's building out these factories. The concern that I have for this company is demand. How many vehicles are they selling right now? Now that we're in a price war as well, it's also contracted their margins, right? Tesla's margins are absolutely unbeatable in the electric car industry because they have rethought manufacturing from the ground up, literally from the raw materials all the way up. They've rethought the way cars are manufactured, and they own and are able to tune that entire process. Xpeng, because Xpeng does not have the quite so onerous manufacturing agreement that NIO does. And eventually, I believe that their manufacturing margins are going to be much higher than NIO. NIO's look higher right now because they're focused on a more affluent market, but that affluent market has limits. That affluent market also is getting more and more competition. You need to make that jump into the middle class here. BYD has really led the charge and kicked everyone's butt in doing that. But the margins on their vehicles are like $1,500 to $2,200, depending on what model it is. And I'm talking, I think it's $2,200 on the BYD Han, which is the competitor for the Tesla Model 3. And the Tesla Model 3 profit margin is like $9,200. All right. So there is no competition when it comes to profitability per vehicle. Yes, it does matter that BYD has grabbed that market space, that market dominance in that particular in the Chinese middle class area, in that class of vehicles like $35,000 to $40,000. It does matter, but they're not making any more profit on that sector of people who own it than Tesla is at this point. Tesla is making a lot more profit because their margins are, 4.5 times higher, or 4.25 times higher than what BYD's are in that same space. And that's kind of the real power of Tesla that people don't realize. Xpeng is kind of facing that same issue when it comes to manufacturing. They didn't rethink manufacturing from the ground up. So they're still stuck with a lot of the manufacturing techniques of legacy automakers that made things more expensive. And one of the reasons that Chinese cars are going to be more Chinese vehicles are probably going to be more competitive in the future is because it's taken a lot of the complication. Electric vehicles taking a lot of the complication out of the matter, and it's taken a lot of the maintenance out, and a lot of the things that can go wrong with a vehicle are going to be software related and in the future. And a lot of the mechanical things like transmissions, like internal combustion engines and their 2,000 to 4,000 moving parts, a lot of those have been greatly reduced and are going to be much simpler and cheaper fixes going forward in the future. So they have kind of a narrow needle opening to thread here in order to get to success. But there's a way that they're aided and a lot of Chinese auto manufacturing brands, because of how much local governments buy into them, they simply aren't allowed to fail like Western auto companies are. There are far more auto brands in China than there are in the United States because of that reason. Like by the time you get through their manufacturing permit process, you've got a dozen really important people that now have a stake in your auto company, who also generally have connections to the government or may even work for the government. And that's just one of the things that happens there. That happens to a degree here, but it's just done a little bit differently. So in terms of Xpeng, I am seeing some very positive signs on the manufacturing front, which is going to improve their margins going forward, especially after this year. They won't be spending quite as much of their revenue building out new factories, but I am very concerned about their demand. And if I don't see a bounce back in demand up to the 20,000, 25,000 unit level, I'm going to be very concerned about Xpeng at that point. But I do need to see them grow to that 25, 30,000 unit level kind of by the end of summer in order for me to continue to have confidence in this company. And I will say that my confidence has been a little bit hit in Xpeng recently. Not so much about the technical numbers that are going to come out tomorrow in terms of revenue or in terms of earnings loss per share. I understand where that money is going. It's going to constructing new factories. That's where it's going. So, yeah. So the and they do have quite a bit of support in terms of loan facilities from local governments. You have these local government agencies there that try to develop these industrial parks, and they have a lot to do that. NEO also has NEO Park that at some point we're going to see more movement on that. I need to check into that. I haven't done that for a few months. And of course, Xpeng is starting to export in earnest overseas at this point. So, yeah, that's my concerns on Xpeng. So let's talk about Moneyline earnings news. And I did take a look at investor relations. Let's see if my operates today, and we can bring this up. One of the things about Moneyline, super customer acquisition. And when I say customer acquisition, don't look at the number of products that they have for right. The number of products like 0.5 million and all that. It matters a little bit less because they're doing a lot of products. More, but they're doing it right now. The commission is very small, but that sold. Their average per customer is $8, and their cost of customer is $8. So those economics really work. I haven't seen marketing work out. So let's look at this. This is a really tiny company in terms of market cap. Their entire market cap may be like $250 million at this point. They've got roughly $300 million in debt. So they do have an issue raising money for expansion and for marketing going forwards. And what they have to do is rapidly improve the cash flow of their business and get to profitability. And yeah, I'm stalling a little bit until this came up, but let me say that their pathway towards profitability is quite a bit faster than you might think. Since 2019, they've averaged 100% compound annual growth. Full year 2020 was no different. They came really, really close to 100% annual growth, right at 99% there. So they are scaling. I said that 6.5 million total customers, 12.9 million total products. I wouldn't pay that much attention to their product count just yet. I think that's going to come a little bit down the road. Like I said, their way of monetizing clients is quite a bit different than it is for SoFi. I would expect that their customer acquisition cost is probably going to rise pretty precipitously as they engage in more referral programs like SoFi does. SoFi gives out like $300 if you refer a loan to, or like someone who opens up a loan. And in most of my recent videos, I've actually put a link there. If you guys are thinking about getting a loan, I would get a $300 check from that. Haven't gotten any yet, but it would be nice to get some. And then if you open up an account or something, you get like $25 in stock or something like that. But if you look at the total number of customers that are added, each one of these represents about $70 in annual income. The amount of, and this is concerning, you're going to make more money off of your first party products, right? And you're going to make more money off your first party products. And there are about 10% in third party products. At this point right now for Q4 of 2022, they're at 34% first party products and 66% third party products. That's great if they're doing this enormous volume of third-party products that the revenue more than makes up for that, but they've got more bang for their buck with their first-party products where they control all aspects of pricing and cost. So we were looking at a little bit of a slowdown in growth. And it's a little too early for me to say if this is a natural slowdown in growth or this is not them getting in front of enough clients. Like as the company grows, is this a natural slowdown in growth? So here's the thing. They reached positive earnings before interest, taxes, depreciation, and amortization in December of 2022. That is not reflected in the numbers, positive EBITDA, because it was just for that month. Okay. I don't know what they're doing going forward, but it looks like, it looks like going forward, they look pretty strong. So they're still at less than $10 customer acquisition cost. They added about 1 million clients last month. Our last quarter, they reached quarterly adjusted revenue of 92 million in Q4 of 2022, and that's up from 54 million in Q4 of 2021. MoneyLion is really trying to balance their sources of revenue between institutional clients and retail. And here's where they talk about their first party product offers versus their third party product offers. So their loans right now are all third party. There's a tremendous amount of money to be made in loans. Third-party product officers are really being paid an origination fee on this. I would love to see some of this move over into first-party products. Their travel and yield savings, home loans, and all that's done third-party right now. They don't fund any of these. They are really a financial facilitator at this point. And that's kind of my issue with them right now is they are really a marketplace at this point. And they're not doing all of the things that say like a SoFi is doing to get ahead. So that's kind of one of my concerns. There are a few things that are missing off of this report. I want to do a little more research before I concentrate on that. But customer continued strength in customer origination performance. So originations were up 11% last quarter. In Q3 of 2022, they were only up 2%, but let's remember that consumer lending really took the brunt of the economic bashing last year. And so those numbers recovering like that is pretty good, but still a little too soon for me to say if it's all, puppies and sunshine here in the future for this company. A little too early to say that. Revenue was up 71% year over year and 8% quarter over quarter for last quarter. If you look at their annual adjusted revenue, that's where we're really headed. That's at 99% growth. And this is one of the things that their goal is to have a 50-50 balance of consumer and enterprise business. And they're actually dropping back and they're actually doing more consumer business and less enterprise business. And a lot of their enterprise business is software as a service fees, affiliate fees, software as a service and platform fees, advertising fees, and influencer, creative media, and content management fees. I think that the software as a service and platform fees are probably going to be their biggest moneymaker, and everything else is going to be secondary to that. And that your software as a service business is not going to be really profitable until it scales into an enormous, enormous amount. So, pathway to profitability. This is the key right here. It is not inconceivable that as early as next quarter or the quarter after that, that Moneyline is profitable. It is not inconceivable. And the last time I looked at Moneyline stock today, it was like 50 cents a share. It is entirely reasonable to me to take a risk with throwaway money and buy a bunch of this stock for very little money. And this is one of the things I did with Neo back when it was $1 something a share. I bought, thousands and thousands of shares for almost nothing. White knuckled it for a few months until I was positive, because I wasn't positive for the longest time. And then it went up to $73 a share. Of course, I didn't sell then, but I ended up getting out between like $28 and $18 a share. It's a 10x return overall for risking very little money. This case, I don't know that it's going to 10x anytime soon from here. But if we're looking at buying it at 50 cents a share, 57 cents a share, and 3-4 years down the line, we're looking at 50 cents earnings per share at that point. You look at a multiple for this of anywhere from 15 to 25, depending on how the market wants to value it. It can very easily be worth a 10x in the future. I'm not saying this is going to the moon. I'm just saying if we see that level of profitability, and this is what we're looking for here at this quarterly EBITDA at negative $6 a share for the full Q4 of 2022. They are claiming that in December of 2022, they are EBITDA positive, which means that actual GAAP earnings is not far behind, probably 2 quarters at 2 quarters, 3 quarters at the latest, 4 quarters at the latest. Earliest could be next quarter, right? Next quarter. So that could be a big deal. So Q1 guidance is Q1 2023, they're going to be between negative $4 and $0 EBITDA. That is a projection. That is guidance. I don't know when exactly. We're at the end of the quarter, and I don't know when they're going to report that, considering it took them almost a quarter to report Q4. So we have a while to wait until we get their next the next earnings report, but they are targeting positive adjusted EBITDA for full year of 2023. Anyway, I went through this on Tuesday morning when it came out, but with all of the stuff happening in my life in the last couple of days, I haven't had a chance to make a video about it or talk about it, but I am fairly positive on them at this point. But I'm pretty far down on this stock. I'm just going to hold it. And like I said, profitability is not that far around. They have averaged 100% revenue growth since 2019 or 2020, and they're only projecting in their guidance 30% revenue growth, right? So that's actually disappointing guidance, and I suspect that they're playing around with guidance a little bit, and we are actually going to see fairly good adjusted revenue growth. The concern that I have is that eventually they're going to have to start marketing more, and that's going to cost. And it's going to cost in one of two ways. Either they're going to raise money to do it, or they're going to cut into their adjusted EBITDA. They do have enough cash. I think like 173 million in cash, and then like another 30 million in short-term investments. And that's enough to give them a runway for a couple of years in order to really get to solid profitability. But they may make a conscious choice here at this point not to do that. So instead of racing to grow at all costs, they may be racing to profitability at all costs to pump up their share price to give them the opportunity to go out and raise more money. So, yeah. So I believe that you remember saying the SP could drop to around 3,800. Do you think the banking saga could make or cause it drop any further? I think we're pretty close to the bottom right now. So I did this long video the other day on on the warning signs that I have to look for a market bottom. And I didn't use exactly the same metrics that CNN Business has. I don't really use CNN Business very much to look at the video that I did talking about signs of signs that I look at that tell you the market is close to doom, and these are contrarian indicators, meaning if the market is telling you that greed is driving the market or fear is the market, you want to invest when extreme fear is driving the market when we're below 25 here. So that was yesterday, right? You want to avoid investing like the plague when extreme greed is driving the market. And right here in this area is your dollar cost averaging time. I don't know where the market is going. It could be up, it could be down. But if you dollar cost average over time, you're going to end up acquiring the majority of your shares at below the average cost of those shares in that time period. Where you win is when this is 18. That's where market of its lowest point generally is after that. We hit that point yesterday and the day before. It was at 15, 17, 18 on Monday, Tuesday, Wednesday. Today it's back up. Fear has declined quite a bit. So they use most of the same sort of all different what they didn't use, but they did use like the put call ratio, put call ratio. Thank you so much, Shula's Joe, for the super chat. I do appreciate when I get those. So they're using market momentum, which is the 5-day moving average of the S&P 500. I look at the 200-day moving average. The RSI, relative strength index, it's still in the greed area. The stock price breadth, meaning how many stocks on the market total are moving. And right now it's extreme fear. Almost everything is down. So this says that on any day, thousands of stocks are being bought and sold. And this looks at the volume of shares that are rising, volume that are falling. And today that was an extreme fear. This is the one where it peaked at 116. The biggest peak I've seen is at 1.5, 150, and that was back in 2008. And that was like extreme fear. Like people were buying puts and paying ridiculous amounts of money. So I ended up buying a couple of times First Republic shares this week and turning around right away and selling calls on them. And because there was so much volatility in the stock, the call prices were ridiculous. I was getting like $690 for calls that were expiring at the end of this week. Like I bought the stock at 31, put a call on it, the first one at 55, and got paid $690. Ended up, during one of the drops, selling the call or buying the call back. And then as it rose again, sold the stock and then did it all over again, rinse and repeat this morning. Okay. So for the last 3 days, that's what I've been doing with like First Republic, just going around all of the trading halts on that as well. I'm probably done doing that at this point because they've announced a bailout. I wasn't 100% certain, but I was fairly certain that a bailout was going to be arranged. This time it's not arranged using taxpayer dollars. It's arranged by using the stronger players in the business. And the number of banks that are in trouble, large banks, is far smaller than it was in 2008. And the failure has everything to do with very poor risk management. So junk bond demand, safe haven demand, two things I also talked about in that video. The VIX demand, another thing I talked about in that video, put and call options. So the stock breadth are two things that my video. All right. So yeah, I think that the banking crisis is fairly. There is going to be one or two other banks that dropped this year, but the number of banks that fail in the United States will likely be under 10, maybe even under 5. That's how overblown I think this is. Also, Michael Will, I don't think that the S&P 500 drops much more than 3,800. I believe that we stabilize at this point. I don't think it's going to get over 4,200 by the end of June. I don't think it's going to go much further below 3,800. If it does go below 3,800, it's probably not going to be below another 50 points or so. And a lot of that has to do with just everything that's going on right now. The fact that at least depositors have been guaranteed that whatever they have on deposit is going to remain. They're going to have access to their money, which means that businesses can function. And that's what we really want. Bondholders and shareholders are going to get hosed, though. So you probably will see more market volatility, which, to be honest with you, I'm not having any fun with it, but that's not my real concern. My real concern is liquidity in the economy. I want business to be able to function. I want them to be able to take money for sales, put money in their accounts, take money in their accounts out. Brian Lee, hey, how's it going? If you have any questions, let me know. We're at 40 minutes today. I was hoping to get off at about 50 minutes. So if you have any questions, let me know. I'm happy to try and answer anything. This, despite the fact that I haven't gotten a lot of questions on this has actually been one of my favorite live streams in a while, because I've had to talk about some things that are like super real in the economy. So bank is scary in the last few days. Can you share your view on SoFi, as I'm holding lots? SoFi is not going to be affected by this at all. They didn't have any assets at all with Silicon Valley Bank. They had a $40 million lending facility with them, which they could borrow $40 million from them. It is not clear to me that they actually had borrowed anything from them at all. From what I could see, it didn't look like they were using that lending facility. And if they were, it was a small percentage of their overall available cash. They are in a really strong position, because SoFi has a problem that a lot of banks don't have right now, which is they have far more in deposits than they have than loans, right? They haven't been able to loan out their money fast enough to have the issues that most other banks are having in the fractional reserve system. The biggest problem that they might have, and this is a total might and a total conjecture, do not take this seriously for a second. So they brought in, they have about $8 billion on deposit. They have about $12 billion out in loans. Most of that, of course, in loans. But we're talking about what they have on deposit. They have not been able to get rid of cash off of their bank accounts fast enough to account for all of the deposits they're bringing in. So the worst thing that could probably happen right now is that they can't pay that 3.75% on the interest rates that they have, and on their liquid deposits, and they have to lower that rate a little bit. And that would actually be bad for their ability to collect deposits. But that's actually good for the business overall, because they have to pay interest on all of those deposits, right? And they're able to pay interest on that deposits if they're able to make loans, if they're able to sell their products. If they aren't able to do that, you would probably see a decline in interest. But I don't think they're at that point now. And as far as what do they have to do with whatever remember, they just got their banking charter last year. They took over a small bank that I think only had about $50 million on deposit, not billion, $50 million on deposit. And they would have been, because they were a really small bank, extremely, extremely conservative in their lending. It's probably going to be mostly residential. Yeah, I actually hate the idea of the lawsuit. It's not that I don't want student loan repayments to start. It's not that I don't want student loan forgiveness as well. I do definitely want student loan forgiveness, largely because it's just not good for us, for the economy as a whole. Back when I went to university, I didn't get scholarships, but the state paid the vast majority of the cost for me to go to university. Like, my total expenses were like $8,800 a year for tuition, books, and the apartment that I rented, right? It was like $8,800 a year. And I was able to work turnarounds at a refinery, wait tables, did a little programming here, worked in the summertime on a supply boat that ran supplies out to the oil rigs, which, by the way, that job was hell. But I was able to do all of that and pay for school and escape with almost no debt. I mean, it was like less than $5,000 in debt. And then the second time I went to school to UCSD here in California, that cost me like $33,000 with my housing expenses, tuition, and books. Okay. That's a huge jump in like 10 years. Right. And they were both state schools that I went to. Today, if you did the same thing, your housing expense plus your tuition, rent, and all that would be like $55,000 a year to go to the same university that I graduated from in 2006, and a Texas university that I didn't finish at the Texas University in like 1997 or something like that when I left. Right. That is all. I mean, that's an enormous increase in tuition expenses over the years. Some of that is attributable to inflation. Most of that is attributable to the lower share of state funding to pay the expenses of college education. Once boomers assumed power in the 1990s, they simply started cutting funding to higher education, and they've done that every year since 1995. It hasn't improved since then. So this student loan problem is a problem that we voted for, mostly by putting people in state legislatures that were not willing to adequately fund higher education. We need higher education in order to compete at the highest levels at university. So let me see here. What happened to all the Chinese stocks in the last 2 weeks? It keeps going down. I'm holding Neo, Futu, QFIN. Are they talking about delete? No, they're not talking about delisting at this point right now. From what I understand, negotiations about all that are going just the way that negotiations always go with Chinese regulators, which is it's a long slog and nothing actually gets signed until the last second. But they are good faith professional negotiations. They're just bargaining as hard as they can. It's not going to be wrapped up early. It's going to be wrapped up at the deadline. So I would expect even more volatility. This is what's going on right now is really about fundamentals. Demand is not quite snapping back in China like we thought it would at this point. Let's remember those are trailing numbers. We'll have a better idea of what consumer demand looks like in China here in the next couple of months. After, of course, like all COVID restrictions have been lifted and everything at this point, or at least almost all of them have. We are also looking at demand shifting at this point. Just like in the United States, the economy didn't snap back to where it was in 2019. Our economy looks radically different than 2020. I remember at the beginning of the crisis in 2020, I told everyone that we will never go back to normal. There will be a new normal going forward where the economy looks very different and money flows look very different. That is also going to be the case with Chinese stocks as well. So what worked in the past will not necessarily work in the future. And so right now, Brian, everyone is losing on everything. The breadth of the market decline was staggering. And I wouldn't even hold my breath at Tesla being it's at 185 or so at close. I wouldn't hold my breath at that. For a reason unrelated to stock market performance, I have a lot of money in cash right now because I want to invest in a new business that I think is going to do really well. So I haven't suffered from quite so much volatility just over the last couple of days. But even so, if that investment gets delayed, I will probably sell way out of the money puts on Tesla and be able to generate a couple $1,000s a month in income while I'm waiting. Just because I think that there's going to be a lot of volatility through the end of June. At the earliest, before we see the end of volatility, is going to be the end of June. That's the earliest. The big test is going to be next week at the Federal Reserve meeting. Is the Fed going to raise rates by 0.5 point? I don't think so. Are they going to raise rates by 25 basis points? I think there's still a fairly good chance that they do. But I think that chance is about 40%, right? Unless they come up with a system-wide way to help out some of the banks, or all of the banks rather, that have unrealized losses on their balance sheet due to the fact that interest rates went up so quickly. Interest rates went up so quickly that the banks were actually planning on a pause or a reversal in interest rate rises by the end of the year, that they didn't take these assets off their balance sheet. They should have done it earlier at a smaller loss, is what I'm saying. Done it earlier at a smaller loss, invest in things that have higher yield to maturity at that point that are going to be less affected by movements in interest rates. the higher the coupon rate, the less that you're going to be affected by interest rate changes. So if you've ever studied something called zero coupon bonds, these are the most volatile bonds in the market because they actually don't pay any interest. You just get all the money back at maturity, right? So you buy it at a discounted amount and then you get the money back at maturity. These zero coupon bonds are the most volatile bonds that are out there, right? And the higher the interest rate is actually paid on the bond, the less volatile it is. One of the reasons why these banks are suffering so badly now is that they bought these bonds at yield to maturities that were sometimes sub 2%. So Brian says, I think it will rise by 25 basis points. This is a trap. Wait till the end of the year. I don't know if it's a trap or not. You just have to keep in mind that the Federal Reserve does not care about your 401k or your investment account. They care about asset price stability. They care about price stability in the economy above all, and full employment. That's what they care about. They've already taken full employment off the table. They've already said we care less about full employment than we do about asset price stability. Okay. Yeah. And I agree with you too, Brian. I think that, that banks are a good long-term hold. They tend to do very, very well in times of rising interest rates, but it takes a long time sometimes to get a return on investment. But they are a good buy. And I think that the bigger banks are probably if you don't have an appetite for risk, the bigger banks are the way to go right now. I really do. But yeah. So anyway, I have a lot of things to do today. We reached the time limit that I wanted to spend on this today. I wanted to thank Shoeless Joe for the super chat, and it's been a long time since I've received one of those from anyone. I don't do it for that, but it's always nice when I do. Thank you very much. I'm going to enjoy my cup of coffee, or that could actually buy me a taco here, by the way. Thank you very much, guys. And I will see you on Monday. I think I'm free on Monday, so I'll see you guys on Monday, and I'll be putting out more videos next week as well. Thank you so much, and have a nice day.